Hey, good morning, everyone. This is Chris Verrone, head of technical and macro research here at Strategas, the investment strategy arm of Baird. Thank you, as always, for joining us. It was great to see so many of you in Milwaukee last week as well. Certainly a lot to talk about as we close the book on the first half of 2022, but we'll narrow it down to 5 topics today. Number one, I want to highlight how our big picture thinking really has not changed here. Second, we'll look at some tactical considerations that are perhaps a bit more nuanced. Third, we'll look at both leadership and credit and what signals we can derive from those going forward. Fourth, I want to talk about 10-year yields. They briefly traded to about 350 this week for the first time since 2011. What are the implications of that? And then lastly, we'll highlight both some groups that are improving here as well as some that are deteriorating as well. But in terms of where we begin, our big picture thinking really remains unchanged. Something we've been talking about all year is one by one, more and more stocks are below where they were pre-COVID. 50% of the Russell 1000 is back to where it was pre-COVID. So our general thinking was and has been and remains that the S&P will also trade back to where it was pre-COVID. Let's call that somewhere between 34 to 3,500 on the S&P. I don't think that's an unreasonable target for this bear market. It also corresponds with some of the support work that we've noted as well. The 50% midpoint from the COVID 2020 lows to the January 2022 high is roughly 3,500 on the S&P as well. So I think that's an appropriate reference point. I would emphasize, though, something we've said all year. In bear markets and in downtrends, it's more about resistance on top of you than it is support. You could certainly bounce from here. We'll talk about that in a minute, but there's a lot of resistance still on top of this market. I think one important observation to distinguish between a tactical bounce and what I would describe as a major bear market low, when you look at the number of individual stocks making new lows, believe it or not, that actually tends to contract or improve the closer you get to your final bear market bottom. We haven't seen that yet. This week, we got a new cycle high in the percentage of stocks making a new 52-week low. That stands in, I think, pretty important difference to how the market bottomed in 2008, 2009, or 2002. So for example, even though the S&P bottomed in March of 2009, most stocks actually made their lows in October and November of 2008. By the time you get to the final index low, most individual stocks have already bottomed. I don't think we have that condition here yet. Now, if there was a silver lining in what otherwise was a very, very bad 5 or 6 last days for equities, it's that you have finally begun to see what I would call some indiscriminate selling. When you look at the weakness over the course of the last number of days, really no distinction was paid between, say, an energy stock or a tech stock or a material stock or a utility stock and a discretionary name. Zero distinction was paid. You tend to see that as oversold conditions start to develop. You tend to see that kind of in the later innings of a decline. We had negative 46 to 1 breadth on Monday. So for every one stock that was up, 46 were down. That's about as bad as you do kind of internally. You can bounce from that. But again, back to the bigger picture, I wouldn't want to confuse a little tradable rally here or a bounce with what I still think is an ongoing downtrend and an ongoing bear market. Now, what would change our mind? Well, I think importantly, if this market's really going to turn a corner, we're going to need to see more risk-seeking leadership. A relationship that we've talked a lot about on these videos over the last couple years is that between discretionary and consumer staples. Now, we equally weight this, so this is not Amazon versus Procter & Gamble. What is the average consumer cyclical doing relative to the average consumer staple? This is still right back on the lows. And when we think back to March, April, May of 2020, kind of coming out of COVID, this was really one of the important indicators for us that really got us bullish so quickly then. I mean, discretionary leadership in the early days of COVID was pronounced. It was screaming early cycle. I think the continued underperformance of discretionary today would still be suggestive of a problem. So I think at a minimum, this is one relationship we would want to see positively inflect going forward. We have not seen that yet. The other thing I would also note is that by the time you get to your final bear market low, typically credit conditions have already started to improve. I mean, it's another way of saying credit tends to be less bad even as the market makes lower lows. That hasn't happened here yet either. We had new highs in high yield CDS this week, particularly in Europe. Credit looks pretty recessionary here as well. Now, one of the things we continue to find pretty remarkable just in terms of flows and positioning, still our preferred favorite sector in the market is still energy. And I recognize energy has not been immune from some of the selling this week, but importantly, credit conditions in energy did not deteriorate this week despite the equity being hit. I am much more willing to step in and buy weakness in a sector when credit conditions are stable. That is largely the case still with energy. I also think very notable when you look at year-to-date flows for a sector that's up 50% or nearly 50% this year, the flows into energy have remained very, very benign. You do not have this embrace or this endorsement from the street of this sector. I still think it's interesting from a contrarian standpoint. The language we've used with energy this year is energy may be, quote, overbought, but it's not overowned. And at 5% of the S&P, it is certainly not overowned. We like simple analysis in our work. I don't think I could tell you anything more simple than the following. The last time oil was about 115, 120, energy was closer to 15% of the S&P. It's 5% today. So we still think ultimately there's more room. This is the one area of the market where we're particularly interested in buying some weakness. Now, of course, the other big story this week were 10-year yields briefly hitting 350. Highest we've seen since 2011 on US 10. So we put together this little simple today versus then list of some financial benchmarks, what they look like today with yields at 350 relative to where they were the last time 10-year yields were 350 in 2011. I think the big differences here are the forward PE of the S&P still 16 times today. Last time yields were 350, forward PE was closer to 13 times. The largest weight in the S&P, as we know today, is currently Apple. Back in 2011, it was Exxon. And then perhaps most importantly, last time 10-year yields were 350, inflation was 2.7, clearly still very, very elevated today, over 8%. One or two last things at the margin. You know, one of the wild cards I think in our work right now is some of the very subtle improvements we're actually seeing in China. It's the one area in the world where I would describe as having trough economic data. So you have first decile economic data, which is typically a decent place to be putting some risk on. So I don't think it's a coincidence if you look at Chinese stocks relative to NASDAQ, you actually have started to see some outperformance there. It's a tough intellectual bridge to hurdle, but I do think in the spirit of a contrarian call, there has been some subtle improvement in China this week that I think is worthy of our attention. As far as some groups here, just to end, continued leadership from aerospace and defense. This remains one of our favorite groups within the industrial sector. I think important message there geopolitically as well that these stocks continue to outperform. I would also continue to emphasize the pharmaceutical names, which remain leadership here as well. On the flip side, continued weakness from semi and semi-cap equipment, new relative lows there this week, just simply not leadership in our work. And then lastly, I think it's worth noting, despite if you're like me, you've been in a lot of airports the last couple of weeks. Despite very busy airports, very crowded planes, this reopen trade still doesn't work. This is hotels, restaurant, and leisure relative to S&P. Remember, markets are discounting mechanisms. I think this is reflective of the market discounting a weaker position that the consumer finds itself in kind of as we head through the remainder of 2022. So that's what we have today. Thank you, as always, for your support of our work. Feel free to reach out to me directly. Again, Chris Verrone from Strategas. Look forward to talking to you soon.